So today I'm excited to have Erik Oliver on the show. Erik, thank you for giving us your time and just give us a quick introduction of your experience and what your business is and what we're going to be talking about today for the listeners.
Sure, Abiel. I appreciate you having me. So, kind of my background, my degree's in accounting, and I have been with Cost Segregation Authority for 6 years now. We work with investors and CPAs across the country on reducing tax liabilities through cost segregation, as well as some energy credits. And so that's what we'll be trying to focus on today mostly.
Cost segregation is a big part of our multifamily business. And for those listeners who are not using cost segregation, you are missing out on a big tax incentive. And it's something that everyone should get educated on and understand the basics of it. There's a lot of detail into it, but if you come to an expert, they should be able to guide you. Let's start off with the tax implications that real estate investors have. You could touch a point on that before we get straight into the cost segregation.
Yeah, no, that's a great question. So a lot of us get into real estate. One of the real benefits of real estate, obviously growing long-term wealth, those types of things. But one of the big benefits is being able to reduce your tax liability. So unfortunately, we all have to pay taxes, but if we can limit the amount of taxes we pay, that gives us more cash flow, more money to go put into new deals and create that long-term wealth. And so, when you invest in real estate, one of the benefits is something called depreciation. So I'll just kind of touch on that. Depreciation basically is a non-cash expense. So it's no different than any other expense you might have in your business, but it's a non-cash expense that typically, you think about multifamily, you get to depreciate your asset over 27 and a half years. So let's just look at it at a small scale. Let's say you buy an 8-unit, you find a real good deal on it, you pay $275,000 for it, $275,000. You're essentially going to get a $10,000 write-off every year for the next 27 and a half years that comes off your taxable income. So if your income is $150, instead of paying tax on $150, you have to pay tax now on $140 of income because you have this $10,000 depreciation expense that shows up on your tax return. And so depreciation is a great way to reduce your tax liability. And if we can accelerate those deductions instead of just taking the 127 for the next 27 and a half years, it adds even more cash value, more benefit up front. And there's a number of reasons on why you'd want to do that.
Now, let me ask you, when it comes to depreciation, what is the holding period, the best strategic length to hold a property to get the maximum amount of depreciation on it?
Sure. So if you're doing a cost segregation study, then you're going to break your assets up into 5, 7, 15-year, and 27 and a half year assets. So usually somewhere between that 5 and 7 where you've fully depreciated all your 5-year assets. So you're going to get a bunch of write-offs in those first 5 and 7 years. That's kind of the typical sweet spot. But again, obviously other factors play into that. But in terms of just depreciation, when doing a cost seg study, if you can hold it for at least that 5 or 7 year, you've taken a good portion of your deductions early enough that you've been able to reduce your tax liability.
So let's say you're an investor and you're turning properties every 1 year. You're kind of technically a flipper, and you're selling properties under 1 year or 2 year, 3 years. This is not a very effective strategy for someone like that, or is it still? There's still some incentive on that.
There is still some incentive. So especially with some of the tax laws that have recently been passed when Trump came into office, he passed the Tax Cuts and Jobs Act, which was a kind of a tax overhaul. He's obviously owns real estate. He understands how real estate works. And so there was something in those provisions that it's called bonus depreciation. So now with this bonus depreciation, even if you're holding an asset for a year or 2 years, there's a rate arbitrage where you're taking your deduction at a high rate and paying it back at a low rate and saving the spread. And so it doesn't always apply on the smaller assets because that spread isn't always big enough to offset the fee of doing a cost seg study. But anything over $1 million absolutely is worth, even if you buy it in December, you turn around and sell it the following tax year in March, you're going to get a huge write-off in December against your ordinary income at, let's say, 37%. Even if you sell that property in March the following year and have to pay all that depreciation back, you're paying it back at either 20% capital gains rate or a 25% recapture rate. So you're saving that 12%, and that could be tens of thousands, hundreds of thousands of dollars, depending on the size of asset.
Now, when you mean the size of asset, I know you said the ideal space would be $1 million. Does it matter the size of the property? Like, no, it's just the value.
Yep, your depreciation is all calculated on a value on your purchase price. So yeah, you're looking at just the value. The size of the actual property doesn't matter. And that $1 million mark, I just want to make note, that's if you're going to sell it within a year or two. If you plan on holding a property for 3 to 5 years, you can go down as low as $150,000, $200,000 assets, and still you're going to save $10,000 or $15,000 in taxes. You might have to pay $2,000 or $3,000 for a study, but you're still coming out ahead. $12,000, $15,000 on even the smaller assets.
So I'll tell you something that I know that it's something listeners want to learn, and also for myself.
Sure.
Let's say I'm underwriting a deal, and I'm about to buy this property or about to get under contract. At what point of my transaction do I engage with you? Do I reach out to you and ask you or hire you to help me, structure this cost segregation, or kind of get an idea, especially when you're raising money with investors? I think it's a good, strong selling point when you could kind of give the investors an idea. If our business model is to do this in this period of time, this is what we're going to save in a cost segregation. Right. Do you help out your clients or your investors like that?
Oh, absolutely. So I agree with you 100%. The earlier you get us involved, the better your numbers are going to be, and the more accurate your numbers are going to be when you're sharing it with your investors. So quite oftentimes we work with investors who have a property they're looking at. They haven't necessarily put an offer in on it, but they're looking at it. They'll call us and say, "Hey, Eric, can you run some preliminary numbers for me?" And I'll look at the property, run some numbers for them, and say, "Hey, here's what we can anticipate in the first year in terms of depreciation." And now they can put that into their metrics and get back to their investors and say, "Hey, investor, if you were to invest $100,000 on this project, you're going to get an $80,000 depreciation expense in the first year, or a $70,000 depreciation expense."
That's awesome. That's amazing. Yeah.
Yeah. So you can really use it as a marketing tool, because some of us are limited partners. We just need a place to park our cash. Some of us need a place to get a tax write-off. Maybe I'm a high W-2 earner, and my spouse is a real estate professional, but I've got all this income coming in from my W-2 job, and I need to go find a tax write-off. Well, that's a great way for you as a syndicator, or you for somebody who's looking for investors, to say, "Hey, put money into my deal, and I'm going to give you this massive tax deduction in the first year, and you don't have to do anything for it." So it's a great.
That's big. Yeah, that's big. There's a lot to know that beforehand. I really like that strategy. It's something that we started implementing. So I'm glad that you're open to underwrite deals from the beginning, and build that relationship. That way you can understand what you're going to save in the future, and especially for investors.
Yeah.
What is the impact of the tax reform that you? Can you educate me a little bit on that? What's happening?
Sure. So in 2017, at the end of 2017, Trump was our president. He kind of did a tax overhaul, and he made some changes to the tax law in terms of real estate investing. So one of the things is it's called bonus depreciation. And bonus depreciation has been around for a number of years. I think it was initially put into place. The government uses bonus depreciation to kind of stimulate the economy when they need it. So sometimes it's 30% bonus. Sometimes if the economy is not doing well, they'll say, "Well, we're going to give 70% bonus this year." And what bonus is when it was first enacted, I don't think it had real estate in mind, because in order to be eligible for bonus, your asset has to have a depreciable life of 20 years or less. And so like I mentioned, multifamily apartment buildings is 27 and a half years. Your commercial buildings are 39 years. But it was mainly for, you think about, go buy a bulldozer that's a 15-year asset, let's say, and you get to take, instead of depreciating that bulldozer over 15 years, you get to depreciate that bulldozer. You get to take 80% of that in the first year as bonus depreciation, and the other 20% gets spread out over the next 14 years.
Oh,
so
wow.
The government was allowing you to front load your depreciation as an incentive to go out, stimulate the economy. Well, in 2017, the bonus changed from 50% to 100%. So that's a big jump.
That's huge.
Yeah, huge. And the other thing is it no longer had to be new construction or new purchases. You could go buy an old bulldozer that's new to me because I just purchased it, but let's say it's used. Now I'm eligible for that bonus. So let's take it back a step and let's kind of think about how that applies to real estate. If you buy an existing, let's say I go buy an apartment building today that was built in 1970, and I pay $1 million for it. Well, I can't take any bonus depreciation if I don't do a cost seg because that asset is classified as a 27.5-year asset. But what if I do cost segregation and I segregate that asset into 5, 7, and 15-year buckets? And what I mean by those buckets, Abiel, is I mean your 5-year assets. When you buy an apartment building, you're not just buying the walls and the land. You're also buying a bunch of carpet, a bunch of countertops, a bunch of cabinets, some appliances. All those things I mentioned, according to the IRS, should be depreciated over 5 years, not 27.5. So that's what a cost segregation study does, is it comes in, it takes that $1 million purchase price, and it says of that $1 million you paid for that apartment building, 30,000 of that was for things like appliances. Another 80,000 was for the concrete in the parking lot or the asphalt. And we segregate those costs up. Well, now you've got these buckets that are less than 20 years. You've got your 5, 7, and 15, and you get to take 100% of that in the first year. So it's huge.
Amazing.
It's amazing because let's just use that $1 million building example. If we typically segregate somewhere around 30%, all of a sudden we're going to take, of that $1 million, we're going to take 30% of it, put it into these short-term buckets. And because those buckets are under 20 years, you get to take all 300,000 as a deduction in the first year.
Wow.
Versus before bonus depreciation, you would get to take 1/27th of $1 million, which awesome. I can't do that math in my head, but it's not a lot. You get to take 1/27th of $1 million versus 30% of $1 million, right? And so bonus depreciation has become really powerful for investors. If you own real estate and you're paying taxes in this current environment, you need to get a second opinion because you've probably got a lot of these hidden deductions sitting in your...
You're leaving money on the table.
Yeah, absolutely.
Now, Erik, is there a sweet spot or a typical property that typically takes that when it comes to cost segregation, it's like the holy grail, it's like the perfect type of asset to do cost segregation, or a type of property that you can't really cost segregate too much?
Yeah, no, that's a great question because the different asset classes, we do get different results. So if you think about, if you buy a big empty warehouse, you might pay $1 million for a warehouse. We go in and do our study. There's not a lot for us to segregate, right? It's just a concrete floor and some steel walls, and that's about it. You know, maybe we can take the parking lot and the fencing around the outside and maybe some signage. But typically, you know, on a property like that, we might segregate 20% versus multifamily apartment buildings. It's closer to 30, 35, sometimes it's even as high as 40, depending on the landscaping. You know, because when you buy an apartment building for that same $1 million, you're buying, you know, 20 washers and dryers. You're buying 20 sets of cabinets. You know, if you've got 20 doors, you're buying parking lots, curbs, gutters, asphalt, flooring for all those units. And so multifamily is a good property class to do cost segregation on because there's a lot of personal property in a multifamily. And then you do have some outliers that are just crazy, like gas stations is kind of a weird one. Same thing with car washes. So if you were to go spend $1 million on a car wash, you're really not buying a structure. What you're buying is curbs, gutters, and equipment, right? And so car washes can oftentimes, the whole $1 million gets classified as a 15-year asset, which makes it eligible for bonus depreciation.
Wow.
You're taking the whole write-off in the first year.
Interesting.
Yeah, so that's car washes, gas stations, and then sometimes mobile home parks are in that. They're kind of outliers. Everything else is usually between 20 and 35, 40%. Then you've got those three outliers that are just absurd.
That's good to know. All right, let's jump into the energy credits.
Sure.
This is something I'm dying to learn about. Not too educated on it. So we'll start with the first one, the 179D energy credits. Can you explain to me a little bit about that?
Yeah, so the 179D it's an energy deduction that's eligible for commercial properties. So, and when I use the word commercial, it's a little different probably than the real estate world, but commercial meaning like your retail. When we talk about multifamily, even if it's a huge multifamily, I consider that residential for depreciation purposes.
Okay.
So I need to clarify that. So the 179D is for your commercial properties, anything that gets depreciated over 39 years. And what it is, it's a $1.80 tax deduction if your building is more energy efficient than prior year standards. And so a lot of new construction, this would mainly apply to new construction, a lot of new construction just by the essence of the materials that are being used nowadays and the stricter county codes qualify for this credit. This $1.80 deduction. This $1.80 deduction can be broken up into three parts. It's your mechanical, which is your heating and air, your lighting, and then your building envelope, which is your insulation, your windows, the insulation in the attics, etc. So the nice thing about this 179D is you can actually qualify for, you don't have to qualify for the whole thing to get the $1.80. You might have poor insulation, but you've got good heating and air and good lighting, and so you'll get a $1.20 deduction per square foot. So
per square foot.
Per square foot. So it's $1.80 per square foot total, and that can be broken up into 60-cent increments for those three different components.
Is that the same for offices or just mostly retail?
It works for office buildings, retail. We've done it for self-storage where the lighting and, there's not a lot of
storage. Got it.
You look at the lighting. So any commercial property is eligible for that. You might not get the full 180, but you might, get one of those 60-cent components.
Fannie and Freddie Mac have a very similar incentive for energy saving products on the interest rate. They have a program like that. I don't know exactly the detail, but they have something very similar. If you're using energy saving and you show proof of that, they'll give you a break on a couple of, I think it's like half a basis points that they'll help you out with. So it is something that they're motivating investors to use. Okay, let's jump into the 45L energy credit. Educate me on that one.
Yeah, so this one probably applies more to your listeners, so pay close attention here. The 45L energy credit is amazing. It's a $2,000 tax credit. And the reason I corrected myself when I was talking about the 179D, because that's a deduction. So that comes off your taxable income, and that's how you save money. This is a dollar-for-dollar tax credit, $2,000 per door for energy efficient new construction. So if you're building duplexes, quads, eightplexes, apartment buildings, and you haven't taken advantage of the 45L, you're leaving significant money on the table.
Wow.
It's one of the most underutilized tax credits out there. And I think the reason is, this is just my assumption, is that they don't always reinstate it. So unfortunately, right now, they haven't reinstated it for the 2022 year. So if you go build an apartment building as of today in 2022, the credit's no longer available. However, the new administration hasn't really tackled their tax initiatives yet. They've been dealing with coronavirus. Now we're dealing with Russia. Once they get to their tax incentives, this is an incentive that's usually got bipartisan support, because the Republicans are looking to lower taxes. The Democrats are looking for green energy. And so usually they come together and offer this. So my guess is this will be extended for 2022. But currently, it's only on the books through 2021. So you would have had to build something new, a new resident. Oh, let me state that. It's only for residential properties. So apartment buildings, senior living.
Who takes advantage of this? The developer or the buyer who buys the new construction building?
It would be the developer. So whoever develops the property, whoever has basis in the property when it's being developed. So whoever took the loan out for the construction loan. Would be the one who's eligible to take that 45L credit. Now, remember, it's $2,000 per door. You do have to have a third party come in and qualify it, but it's very similar to the 179 where we're looking at the same things. We're looking at the building envelope, the heating and air, the ductwork, and the lighting. And if it qualifies, if it meets certain standards, then we issue certificates and you get to turn those certificates in with your tax return.
Now, let me ask you something. So we do have some new construction in the pipeline. I haven't looked into what products I'm using yet because we haven't gotten to that point.
Sure.
Is that something you could help out with? So that way, strategically, it's done correct and it makes your life easier and everyone's like.
Yeah, no, that's a great question. We love to get involved on new projects sooner than later, because sometimes maybe you might spend an extra $200 on a little bit nicer furnace, and all of a sudden that bumps you up over the threshold to now be eligible for that credit. So you're making a business decision. Spend $200 more for a higher efficiency furnace, and now all of a sudden I earned a $2,000 credit. Or
get it right back.
Yeah, put in an extra 2 inches of insulation up in the attic, and all of a sudden my building now qualifies, and I'm getting whatever that cost was back plus some. So again, we'll do a free analysis where you can send us the prints and tell us what kind of stuff you're looking at using, and then we can advise and make a business decision and say, okay, listen, if you just bump the furnace up a little bit, or if you just bump the insulation up a bit, these are going to put it over that threshold that qualifies.
Right.
And now you're eligible for those credits.
Yeah, that's how crucial it is to have advice, have a team around you. And I say this because it's something that I've incorporated in my business and in my life. You can't be an expert of everything. You got to allow experts to do their thing. But it's also crucial to engage them early.
Right.
You can't be afraid to ask questions, reach out to your experts in any business,
right.
and just let them know this is where I am right now in this business that I'm about to do. Can you help me make sure I do this correctly from day one? And
right.
It'll take a long way. So that's big, Eric, that someone could engage with you on these subjects that we talked about, and you could kind of give them a path of what's going to help them in the future and save them a lot of money. A lot of golden nuggets you dropped here, man. It was very, very good stuff. Eric, is there anything that you want to add to the listeners, or anyone that is listening that you would like to, just give them some advice on in the multifamily space?
Yeah, no, I think you actually just hit it. One thing that I have noticed in doing this for the last 6 years is you hit it on the head. You've got to surround yourself with people who are experts, and sometimes you have to humble yourself and say, hey, I'm not a great tax guy, or I'm not an attorney, or I'm not a maintenance guy, or I'm not a property manager. I need to go find somebody who's an expert in that field. And so in terms of taxes, in terms of CPAs and real estate, the one thing I would like to just throw out there is there's a big difference, Abiel, between a tax preparer and a tax advisor.
Yeah.
And they cost very different, right? Their fee structure is very different. You can go to H&R Block. You could walk into Walmart today and go to H&R Block and get your taxes done for $125, right? They're going to take whatever documents you have. They're going to input it into their tax software. It's going to spit out a number, and you're going to write a big check to the IRS for your taxes. Versus a tax advisor or a tax planner who's going to sit down with you quarterly and say, okay, what are you working on? What is your expected income? What projects do you have coming down the line? What things do you think you're going to sell this year? And okay, you're going to sell this. Well, what does that mean for your capital gains tax? Oh, you're going to have this huge capital gains tax event? Well, maybe we need to go buy something to offset that. Or maybe we need to do a cost seg study. Or there's a number of differences. And don't be afraid to pay a little extra money for a tax advisor, because the advice they're going to give you is going to be tenfold what you pay them. And I'm not saying this to
so true. No, that's 100% true. Yeah.
Just so you guys know, we don't do any taxes at our firm here, so I'm not saying this for you guys.
I'm glad you clarify that, because that's you're an advisor, so you give guidance in how to do things properly, how to prepare for them. And that's something I'm glad you just clarified.
Yeah, we work with CPAs all over the country, and I've seen the good, bad, and the ugly, and a lot of them get paid just to process taxes. That's how, they've got a client base of 1,200 clients, and that's where they make their money, is in April, when those 1,200 clients come in and hand them their W-2s and they file their tax returns. That's very different than finding somebody. Once you start investing in real estate and you start growing your portfolio and it's becoming more and more complex, it's crucial to go out and find a good quality CPA who understands real estate, who is an investor themselves, who's been through the process, and can advise you on how to structure those deals and how to structure your entities and how to structure everything so that you're not overpaying. I see too many times someone calls me and I'm like, so what was your tax liability last year? And they're like, well, I had to write a check for $300,000 to the IRS. I'm like, wait, but you own all this real estate. they're like, oh, you mean I could have done cost seg on this? I didn't know I could do cost seg on that. Or I could have 1031 exchange, or there's a number of things. And so that's my one thing that I'll
I want to add to that. So for the listeners, you got your own accountant. Don't be afraid to engage Erik and have him take a second opinion. He's not there to compete with your accountant and push him out of the business. He's there to give you an opinion and to give you some advice on strategies and work with your accountant together. So basically, I like that you'll be able to strategically work with the existing accountant and figure out better solutions and maybe something that they missed. I like that.
Yeah. No, that's exactly right. Like I said, we don't do any tax returns at our firm, but we do partner with CPAs that say, hey, we know a lot about depreciation, but we want to partner with you and your CPA around these real estate entities and make sure we're maximizing these.
I like that. I will be engaging you right after this conversation. Erik, man, appreciate everything you've done for us today. Is there a way that listeners could communicate with you? I will also drop a link. How can they get a hold of you?
Sure. Yeah, absolutely. So the best way is just to reach out through our website. So it's just www.segauthority.com. And on there, we have a place where you can enter your information. If you want us to give you a call back, we'll give you a call back, get some information over to you. But yeah, that's definitely the best way. Please use this as a resource. Again, we don't bill by the hour. You can call me. I'll give you my cell phone number. You can call me on my cell phone and say, hey, I've got this question. I think the weirdest question I've got is someone wanted to know how to depreciate deer on a breeding facility in Milwaukee. And they're like, and I didn't know the answer, but I knew that we could find the answer for them. So we were able to get them the answer. But please just give us a call. Use this as a resource.
No, I need to know the answer.
To be honest with you, I think it was like 8 years or something weird. I don't remember the exact answer, but
awesome. That's awesome.
Yeah. So
that's
please,
awesome.
If you have any,
that's a good example. Just don't be afraid to ask.
Don't call me and ask me questions about earned business income or child tax credits because I don't know any of that stuff.
Yeah. Child
if it's
support.
depreciation related or real estate related, please use me as a resource. We're happy to help you guys any way we can.
Awesome, Erik. Thank you for your time.
All right. Sounds good.
All
Thanks.
right.